Thanks for joining in. That's RR Kabul. But let's move on. Max Healthcare reported a strong set of numbers. The occupancies have seen an improvement to 77% levels. The average revenue per occupied bed has also improved by 13% year on year, but it's flat sequentially. Even the international patient revenue is up 25%. Abhay Soy, who's the chairman and managing director at Max Healthcare, joins us now to talk about that. Abhay, thanks a lot for joining in. It was a very strong first half of the year, but give us an outlook on what the second half could look like. Can you maintain the occupancy level at this 77%? And in general, how are the demand trends looking like now?
So I think what you need to look at it is on a year-on-year basis rather than sequentially on quarter-to-quarter, because it is the business does have the seasonality about it, and in that sense, you've seen there's been an increase in occupancy of about 3 to 4%. Do keep in mind that this also includes the distillation that we're doing as far as payer mix is concerned. So we are conscientiously reducing institutional business, and that will have an impact on occupancy. If we weren't doing that, you would have seen a higher augmentation of capacity and occupancy, so to say. Having said that, usually the second half of the year is better than the first half, and we expect to outperform the first half in the second half as well.
Hi, Abhay. Good morning. Nigel on this side, and good to speak to you yet again. Your ARPOB, average revenue per bed, well, that's moved up as well, close to around 75,000 rupees approximately. And I believe that high-ticket surgeries could have accounted for a fair bit of what you've done in the past quarter. Could you tell us, as a percentage of your total mix, how much does it contribute right now? And what will be your export number in terms of ARPOB?
So I think, although the last quarter itself is a medical quarter, that means lower ARPOB, so to say. But we've had an increase, well, ARPOB has been flat. What that means is there's been an inherent increase in the surgical business and the value we've been able to derive from that. And that's largely on account of better payer mix, because we've had an 11% increase quarter on quarter as far as international business is concerned. 25% on a year-on-year basis, but 11% on a quarter-on-quarter basis. That produces better ARPOBs, as well as the number of high-end surgeries. Robotics, for example, we're doing twice the amount of surgeries in robotics now, in the current quarter, in the current year, that we were doing last year. So both these have given a big fillip to ARPOB. Having said that, higher occupancy in this particular quarter is usually due to seasonality, dengue patients and medical patients, which give you higher occupancy, but lesser sort of ARPOB. But all in all, instead of quarter-on-quarter basis, rather than the ARPOB, which is usually expected to go down in the second quarter versus the first quarter, it's actually remain flat, which is quite a healthy sign. But the way to really look at it is on a quarter-on-quarter, year-on-year basis rather than quarter-on-quarter.
So what should it average for the year then?
So I think we're doing about 73,000 for the year, which is up by about
6,000.
Yeah, that's right.
Yeah, so 73,000 of ARPOB for FY24 versus 67,000 in FY23. Abhay, what was the contribution of surgical sales, surgical operations to your overall revenues? What's that number and what can it go up to?
So it's about 55 to 60%, depending on the quarter. 35% of our total beds are critical care beds. So we do a huge amount of surgical business and more critical business. And, it's not only about the surgical and medical mix, but also what comprises the surgical, right? So it's, as we are moving up, both general surgeries and robotics are surgical procedures. But, we've seen robotics, double. So it's a 100% increase in that sort of business compared to, a 17-18% increase in the other business.
Can you tell us a little bit more about robotic surgeries? How many, you've said it's doubled, but how many were done? What's the kind of, extra money that you make on robotic surgeries versus other critical care surgeries?
Well, I won't have the exact number on hand, how many we've sort of this thing, but, in percentage terms, I was given a number that we sort of doubled it. What we've done is we have about 20 odd robots across the country, across most of our healthcare systems. And, the demand for that is increasingly moving up. Usually, it is about 60 to 70,000 rupees more on the sort of surgery, but that's the low end. But it can go up to about 1.5 lakh rupees more as well, as far as robotic is concerned. So now we're offering all three sort of varieties. You're doing laparoscopic surgery, you're doing robotic surgery, and you're doing general surgery. So a patient has an option of all the three price points and all three sort of procedures for the same illness.
Okay, I wanted to understand what does all of this mean in terms of an EBITDA per bed for you? The Q2 in the quarter gone by, your EBITDA per bed was 75 lakhs. Can you build on to this in the second half of the year?
No, absolutely. So I think it was 72 lakhs and it's gone up to about 75 lakhs, 76 lakhs in the second quarter of this year. And as you see us move up the clinical mix, distill the patient mix through higher amount of international business, lower impact of institutional business, hopefully some new rates coming through on the CGHS, which we were expecting last quarter, but hopefully comes in the current quarter. So you're going to see all of that flow down to EBITDA. Most importantly, I think, we're looking forward to some of the new capacities to come in. And you've seen in our previous brownfield expansions, there's been a significant accretion to EBITDA right from the word go within 30-40 days of opening up those capacities. So all of that should pay out to EBITDA. Yeah.
So if you can build on to this EBITDA per bed, does that also mean that you can get back to 28% margins at some point in time? Just trying to understand by the end of FY24, FY25, can you scale up further on margins?
So I think our EBITDA margin this quarter was 28.6 or 28.7%. So it's not a question of sort of scaling up. We're already there. But more than EBITDA in percentage terms, I tend to look at EBITDA per bed. You'd rather do a $10,000 surgery with a 20% margin than $2,000 surgery with a 50% margin, effectively. So EBITDA per bed, there's been a 17% year-on-year growth, and 20% year-on-year growth. And we're looking forward to that sort of journey continuing.
All right, Abhay, final couple of questions before we let you go. International business as a percentage, I think it's around 9%. When do you expect any kind of movement on Afghanistan? Because that used to contribute to revenues, but last few quarters has been dull. So has that come back? Point number one. And point number two, on institutional business, I think it's around 17.5 to 18%. So give us some color on the receivables.
Well, the institutional business, the number of beds it sort of occupies, is down from 29% last year to 25%.
Yes.
Ex-Shalimar Bagh, which is the new capacity, so we went and sort of slowed down on reduction of institutional over there. And this trend should sort of continue. Do keep in mind, our increase, like I said, in occupancy is sort of limited because we are distilling mix at the same time. The international business itself, there was a 25% year-on-year increase and 11% quarter-on-quarter increase. And this is in spite of the fact that Afghanistan, which, like you rightly mentioned, pointed out, was it used to be about 12-13% of our total international business, is down to zero at present. We believe a maiden flight has been started with Afghanistan, but there is no issuance of visas as yet. And as and when geopolitics sort of sorts itself out, we will look forward to having these patients. But that's really something which is out of my jurisdiction.
Abhay, we'll leave the conversation here for now. Thank you very much for joining in, and season's greetings to you.